Welcome to Trading Nation. I'm Sara Eisen. Today we're looking at gold, trading near its lowest level of 2018, barely clinging on to its 200-day moving average. This as the U.S. dollar starts to really gain ground. So how should you trade it as we anticipate more rate hikes this year? Boris Schlossberg is with BK Asset Management. Todd Gordon is with tradinganalysis.com. What do the charts show you, Todd?
Sure, Sarah. Long term, I love to look at this monthly chart of gold just to get the perspective of where we've been. And you can see from 2010, we've traced a beautiful five-wave decline down in gold. We've rallied back, and all of a sudden, everybody was very bullish on gold. But did we just get rejected around the $1,400 to $1,500 level? So I'm starting to see a little bit of hesitation. And then, as you know, Sarah, very well, that dollar is finally starting to search for a bottom, and I'm looking to be a buyer of the dollar. So as much as I wanted to see gold go up and in a risk aversion flight, we just got rejected. So as we get off the monthly here and break down onto the daily with that double top in mind that we just looked at, right around the $1,400 level, let's flip over to the daily. And what you'll see is there we go, right? So there's the first test, there's the second test, and there's actually at this degree of trend, you can see three tests. So we're starting to back away. And then the trigger for me, stop loss selling should occur on those longs who are anticipating the breakout right around the 1,200 to 1,240 level. So if you start to see a push through there, that might confirm the top end is in gold and the low is in the dollar, and you short sellers might be able to take advantage of that move down in Trading Nation.
Yeah, a few failed tests there. Boris, how do the fundamentals of gold look to you with the dollar back on the rise?
I think pretty similar. You know, gold has been sort of going up and down in starts and fits. But basically, I think right now it's just suffering this pullback because of the dollar strength. And also, not just because of dollar strength, but because dollar is becoming a yield instrument again. Gold really suffers when real rates start to rise because gold offers no carry whatsoever. There is always an exogenous case to be made. I mean, if we have some sort of a geopolitical risk, especially if we have a geopolitical risk with Iran, gold is always going to be sort of a harbor of safety and could have a sharp spike higher. But apart from that, if you sort of look forward over the next 12 months and you assume that we're on a slow but steady path upward in rates, it really presses downward on gold. And unless you get some kind of a geopolitical risk move here, it is not a buy in my opinion.
Or, Boris, the one risk might be if the Fed doesn't move as fast as everyone thinks they do because growth slows down and inflation comes back from the 2% level.
That's true, but even in that case, even if the Fed sort of, let's say, goes just one more rate hike, it still provides a dollar, especially on the short term, a very decent carry that it didn't have, during the QE time. And therefore, I still think whatever rally gold has is going to be very limited simply because there's just nothing else out there to make it go higher.
I just want to add to that point, and on a rare occasion, my good friend Boris and I agree. Generally, what you'll see in that 30-year bond in gold is you see a positive correlation. What's happened as the bond market, I'm talking bond price, not yield, bond market has dropped as yields have gone up. We've created a divergence between the 30-year bond here and gold. And I think that might starting to be closed, that divergence starting to be closed. So gold is definitely trading on an inverse relationship to yield. So I agree.
Yeah, and yields are trading with the dollar. Guys, thank you. Boris and Todd, thanks for joining us today, and thank you for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.